Everyone, thanks for taking the time to join. This is Joey Krug from Pantera Capital. And today I'm going to chat with Teddy from Notional. He's co-founder and CEO, and then Drew from Risk Harbor. He's one of the co-founders. We're going to talk about the current state of DeFi, where things are headed, kind of how each of them, see the DeFi landscape, that sort of thing. And so maybe to start, let's start off with Teddy. Could you please kind of give us a brief introduction to yourself and what you guys are building at Notional?
Yeah, sure thing. First of all, thanks for having me on, Joey. So I'm the co-founder of Notional, and Notional is a decentralized protocol built on Ethereum that enables users to lend and borrow their crypto assets at fixed rates of interest. So for those in the audience who are familiar with something like Compound or Aave, Notional's a lot like that from a user perspective, except the rates of interest that you're receiving as a lender or borrower are fixed until a fixed date and time. So it's like Compound, but with fixed rates. Oh, and
Awesome.
also, sorry, Jerry, and just give you kind of some additional background here. So Notional, the most recent version launched about 4 months ago. We currently have about $500 million in assets on the platform.
That's great. Awesome. Drew, tell us about your background and what Risk Harbor is building.
My background is pretty interesting. Got into crypto when I was 13. Wrote my first smart contract when I was 16, and then did a bunch of stuff between. That sort of led me to really start thinking about risk management and DeFi and how to sort of automate it. And so that led me to start building Risk Harbor. But basically, Risk Harbor is automated DeFi protection. And by that, it means, you buy protection from us. And if you have a protection policy from us, if you have money saying Compound and Compound gets hacked, then you can swap your CUSDC, which is your certificate of deposit or whatever. You can swap that for USDC. So if there's any hack event, if you lose your funds, you can come to us and get repaid out. And that's really, something that's needed in the industry because there's a lot of hacks that happen in various smart contracts, due to numerous reasons. And we believe for DeFi to bring in the next billion users, you have to provide some layer of protection for a lot of users that don't have money to put at, high stake gambles.
Awesome. Yeah, that makes a ton of sense. What's interesting about both these products is they're both things that firms like Pantera need. Like if we're putting money in DeFi protocols, like ideally we could buy insurance on that, and then when it comes to lending, the rates in DeFi are very variable, and so being able to lock stuff in is pretty valuable to us. But I guess on that note, Teddy, what do you view DeFi trying to solve or kind of improve upon, versus the traditional financial system?
Sure. So I think what DeFi is really trying to do is disintermediate sort of financial intermediaries and open up access to everyone to sort of get involved. And I think a thing that also that DeFi is trying to do is kind of remove lawyers from the equation wherever possible. And I think that that's something which is a little underappreciated. And it's I think that the cost of lawyers is something that I didn't really fully understand until I started a business. And you see that, lawyers effectively levy a tax on kind of any business transaction, right? And it's something which shouldn't be necessary, right? So you think any kind of rote business transaction requires lawyers to sort of take a look and charge a fee. And I think that that's something which replacing the terms of a transaction from sort of the English language, which is inherently ambiguous, to smart contract code, which is precise, it allows you to just remove that layer. And it also gives you full certainty. So, another thing that you notice is that, when you're using lawyers, basically you still have to trust the other person that they're going to do what they say they're going to do what they say they're going to do. Because even though you have this contract between you and another party, you really don't have any other guarantee that the other party is going to do what they say, right? And your only enforcement mechanism is litigation, which is extremely expensive and time consuming and inefficient, right? And so what it actually means is that you still have to do business with people that you trust, right? Like you aren't able, it really constrains the what you can do with people. And I think that that's a really big difference when you transition from legal contracts to smart contracts, because that is like completely secure. You have full guarantees that like what you think is going to happen is going to happen. And it allows you to do business with anyone without having to trust them. So I think that that allows anybody in the world to participate. And it sort of removes these sort of rent-seeking intermediaries like lawyers and banks and stuff like that. Yeah, so that's what I would say DeFi is trying to do.
Super fascinating. One other thing for the audience, by the way, if you haven't noticed, there's a Q&A box. You can ask questions, and we'll kind of either weave some of them in as we go, or if there's extra time at the end, we'll answer audience questions. Looks like one person asked one already, so feel free to ask them in the Q&A box. Next question I have is for Drew. Like, what would you describe as like some of the key, no pun intended, risks within DeFi at the moment?
Yeah, so I mean, there's 3 risks. One of them being associated with keys. But we look at risk in 3 different buckets. The first is like the most common attack vector, which is smart contract risk. Misspecified code, people having unaudited code, etc. Right? So just failure down to the code level. And this is where most hacks, usually end up happening. But then we actually identified 2 other ones that we look at when we go and analyze a contract to sort of gauge its risk profile. The other 2 are governance risk, right? And this is where the keys pun comes in. You want to understand, who's controlling funds, whether it's one user, whether it's just a 3-person multi-sig, or whether it's a 10,000 person token, a governance token holder governance system. So you want to look at who's really controlling the protocol and how that can affect the protocol at large. In something like where you have a distributed ownership of tokens, you may see firms buy up a bunch of tokens to have almost like a activist investor strategy where they come in and actually start changing the protocol for their benefit. I think we've actually seen that in the past 2 weeks on one of the most popular lending protocols. And then we saw a few months back with Xerox Sifu being exposed as one of the holders of the Wonderland treasury keys, right? So you have to sort of analyze governance risks to understand who's controlling the funds, because that can cause a loss of funds. And then the third one we look at is structural risk. Like if the code works, there is no issue with governance. What's the actual structural risk of the product? Not all products in this print-free money, there's a way it's earning the yield. So for example, in Compound, like we look at what happens when the deflationary spirals, what happens when there's a flash crash of assets, beyond the liquidation amounts, to see and model out, the potential losses for funds for users. So those are like the 3 ones we look at: code risk, governance risk, and the structural risk.
Awesome. And I'm gonna actually weave a couple of the audience questions in now, and either of your views on this would be interesting. There's a couple of questions. They're kind of the same questions, like 2 or 3 at this point, which is like, okay, sounds like smart contracts offer technological enforcement as opposed to legal enforcement. And so, the question is kind of like, are we moving from trusting, organizations and lawyers to trusting programmers? If not, like, why not? What's kind of the distinction there? I have some views, but I'd love to hear what you guys think.
I mean, from our case, it's like, when you buy like protection in real life, you have 100-page policy restrictions and everything that they don't cover, right? You have to somehow read through all these and memorize them in the back of your head for whenever you want to file some type of claim. For us, it's it's written in code, which is hard for normal people to understand that don't understand code. But as developers, our job is to sort of build the Ricardian version of what our code is, right? translate what the code means into human, like what humans can understand these parameters. But for something like what we do, I think it's much better to have it controlled by programmers and by code, because you don't have to sit there and have an arbiter figure out what's the truth and what's not. It's clear cut. It's white and black. There's no middle ground there. No ambiguity.
And I also think that, while not everybody understands code, I think that you don't necessarily have to, like, so there are certain use cases which are pretty standard, and you could have a standard template that does this thing, right? And you've seen it working over and over and over again, and you're using this template and it hasn't changed, right? So whether or not you can understand code, you can know that this tool has done this thing over and over again, and you're using this thing, and that it hasn't changed, right? So like, just to give you a simple example, like, let's say, a VC firm is investing in your token, and you want to do you want to build into the investment contract, like vesting or like a lockup schedule, right? Now you could have a very standard sort of smart contract that implements that schedule. And it could be the same contract, 10 years from now that you use that 10 years from now that you used 10 years ago, right? So while there's an initial sort of, it takes work to develop that initially, but then it just gets continually used, and you can trust that it works, right? And the point is that, after this initial kind of development period, you don't need anybody standing in between you and that tool and charging you a fee to use it. Yeah, so that's what I would say there.
Yeah, I think those are really, really interesting points. It's sort of like, if you think of like if you're a lawyer, sort of think of like, if you imagine like a civil law system that like just kind of automatically worked, automatically was enforced, and the rules had no ambiguity. That's kind of what you get with code. And I think like you also get it kind of plays out, in real time. You don't have to like have these long multi-year legal processes. And also like you don't have to have like reliance that your party will follow the agreement. They're like programmatically enforced. Like they literally have to, otherwise like, your program doesn't work, which is very interesting and kind of very powerful primitive that I think you get from combining like CS and econ and crypto in the way that DeFi does. So with that, next question, Teddy, like what are kind of some of the main use cases you think have gained traction thus far on DeFi? And also, what do you think is kind of underutilized at the moment and might have more usage in the future?
Yeah, so I when I think about this, I think it's always good to remember how young DeFi is and how new this space is. So, it's been around for a few years now. But like, I think like, DeFi summer was sort of June 2020, and that's less than 2 years ago. So the space is still quite new. I think that what has taken off so far is kind of unsurprisingly the very simplest things, right? So for example, something like Uniswap, where it's a simple exchange. So I'm buying and selling tokens, and I think what's crucial here is that the platform that is enabling that to happen, Uniswap, is relatively simple, and it doesn't take any risk, right? The platform itself doesn't take any risk, as opposed to something like a lending protocol, right? Where a lending protocol does take risk, right? And because it has to sort of manage the risk of debtors on the platform, there's kind of it's a more challenging thing to build, and so I think that trading has taken off because it's simple and easy to implement. And I think very simple forms of lending have also succeeded, as you've seen with sort of Compound and Aave. But I also think that what hasn't yet, or what's sort of in the process, I think, of succeeding and is taking more time is protocols that, I think there's a lot left to be done in the lending space. Notional is just one of these protocols that's kind of improving on the base level variable rate lending, right? So it's notional is aligned fixed rate lending. But even that is like, it's a small step forward. And there is a lot to do in the lending space. And I think it is taking more time just because like lending protocols have to manage the risk of users. And because of that, it's a much more challenging problem in my opinion than a simple exchange. And so I think that's kind of taking more time to get to a fully fledged, something that is truly competing with the centralized financial system.
Got it. That's also a great segue to the next question. So Drew, like, and you guys have had experience with this at Risk Harbor. Like, as you think about how DeFi continues to expand, become more widely used, more widely adopted, how do you think traditional finance companies might adopt like this tech? Like, how might they work with players like Risk Harbor? Like, how do you see that over the next number of years?
I mean, if we believe like in basic economics, like the efficient market hypothesis, I think it's like, people will go wherever the yields are highest. I think right now, like there's just too many barriers that prevent traditional firms from like flooding into DeFi. I mean, which is slightly good for DeFi users because it keeps the yields a bit higher. But what I think will happen in the long term is that a lot of these firms will be forced to will start having to move at least partial amounts of their assets on chain into some of these DeFi protocols to compete with their peers. I can sort of lay out the landscape right now. It's like, the current interest rates right now, you're getting like on your savings accounts like 0.25. I don't keep up the daily number, but it's very low, right? And then we look at like compound, even in like a crab market on USDC deposits or like a Yearn, you're getting like 2, 3, 4%, right? So it's almost like 10x what you're going to get in traditional markets. And I think a lot of like fintech apps are seeing this opportunity for their users and, starting to pivot and use DeFi as the source of yield for users. And I'm talking about like a lot of these new fintech apps that provide like a banking like experience with a pretty lucrative savings yield for their users. We've seen a lot of them emerge in the past 5 years. A lot of them are starting to look at DeFi as, this is the way we're going to grow our user base. If we introduce users to DeFi in a very friendly manner with really good UX, they can provide their users with a tremendous yield and attract a lot of inflow of capital. And then I think as that's done, I think a lot of traditional firms are going to have to follow suit and start moving assets into these DeFi protocols to compete because, like, again, 10x more. So if you don't adapt, then everyone's going to go with your competitor. And so that sort of like forces everyone to start considering DeFi at least, if not start using it. And it's great for Risk Harbor, right? Because these users are used to like a US banking system, right? Which has lots of assurances, things like FDIC to make sure that they basically won't ever lose their money. But in DeFi, that's not true. So that's sort of where Risk Harbor comes in. We sort of sit in the middle where we provide protection for users' deposits. So, if fintech app A is moving, 10 million users' deposits into Compound, they want protection to make sure, hey, if these users lose all their funds, if Compound loses all the users' funds, these users are not screwed over. They still have their initial principal at least. And so, as all this capital flows in, we sit in the middle and sort of can grow because of it.
Awesome. So Teddy, talk a bit about how you see the current kind of, DeFi and lending and borrow market. And also what's your opinion on how sustainable the rates are over the long run? What are the sources of rates in the market, as well as the common question that people ask? We'd love to hear kind of your thoughts on those.
Yeah. So kind of going off something I said earlier, is that I think that the development of lending markets just takes more time just because there's a risk involved, right? And I think right now what you've seen is like kind of the basic variable rate lending is pretty well established and it works well. So Compound and Aave have been around for a few years now, and the systems I think have proven themselves. So because I think like Drew is saying, there's just a lot of people think about smart contract risk in DeFi. It's I think one of the primary risks, and if you're using one of these applications, you can look at the application's audits, you can look at if it's been formally verified, all these different things, but ultimately what really makes you comfortable is, has it withstood the test of time, right? And I think that what you're seeing now is that Compound and Aave really have, right? They've been around for years and they've functioned as they were expected to function. And so I think that like the state of lending market now is that this very base layer initial form has kind of solidified and it's proven itself out. And then you have protocols like Notional, which are sort of taking the next step, right? So providing fixed rate lending and borrowing rates for users. And we're, maybe 2 years behind Compound and Aave, right? So Notional is only 4 months old. Notional V2 is only 4 months old, right? And I think that that's kind of broadly speaking where the lending market is at right now. Is we're sort of, we've taken the next step forward. And then as for, and I think that that's really important because kind of, as we see sort of more traditional and more mainstream capital come into DeFi, I think they will look for fixed rates of return because that's what they're used to in traditional markets. And it's also just generally what people prefer, right? And you can see that empirically by just looking at the size of the fixed rate lending markets in traditional markets versus variable rate lending markets. When people have the option, they choose fixed rates because both borrowers and lenders want to know what rate of interest are they going to earn, what rate of interest are they going to pay. Okay, and then as for kind of the sustainability of yields in DeFi, I think that DeFi yields will sort of ebb and flow. And I think there's two main drivers, right? There's the supply of capital in DeFi, and then there's kind of the opportunity set. And the opportunity set is dependent on DeFi's growth. So I think, I think about it like kind of like concentric circles. So DeFi is kind of it's pretty small right now, but as it grows, that opportunity set for capital is going to grow exponentially. And so if you have the same amount of capital and just this really expanding opportunity set, I think that those yields are going to go up. And I think it's going to sort of ebb and flow, right? Because, I think we're on an ebb right now because right now sort of yields are back down to like 2-3%. Maybe there's been, a lot of capital coming into the space. And then, but at some point sort of DeFi will have another boom cycle and that opportunity set will expand dramatically. And there won't be enough capital to pursue all the available opportunities and the yields will go back up. So I think ultimately what makes DeFi yields sustainable in the next, 10 years or however long you want to think about it is just the rate of growth of the DeFi sector. And I think that if you're betting on the sustainability of DeFi yields, that's what you're betting on, is that DeFi native applications and just the DeFi sector as a whole continues to grow.
Awesome. That's super, super informative. Drew, maybe walk through like how you guys think about kind of risk management at Risk Harbor from, I guess, two perspectives. One is like with the software, you guys yourselves are building, and then the other is kind of like, how does the community price risk? I've seen like 3 or 4 questions about this in the Q&A box. Like, how does the community price risk on other protocols in DeFi? Like, what sort of things are they looking at? Somebody asked, does it matter if the devs are anonymous or not? You mentioned the 0x Sifu thing. Like, does that add risk? Things like that.
Yeah, definitely. So I mean, like, the question we get asked like quite often is, what if the protocol that's providing the protection gets hacked? And so like I think there's extra pressure on us when it comes to protocol development to be very good at what we do when it comes to writing new versions of Risk Harbor. And so things we have a lot of internal practices that we follow, which is really stringent code quality standards, peer reviews, doing line by line reviews, like with all developers together in chat. We just go line by line by line, explaining the rationale between every line and challenging every line. And we do all these practices to make sure that in the end this contract can hold, because it is the last line of defense. So if if this fails, then all else has failed, if we can't pay out. So that's sort of how we look at it internally. And then we also sort of apply some of those practices externally, right? So when we go to do integrations, it's almost like a litmus test. If an integration's like well documented, really straightforward, then it's a good sign. The protocol is pretty easy to use. In DeFi, you have protocols that are derivatives of other protocols, usually using the same type of code over and over again. And so it's almost like, if you just forked Uniswap v2, then your code's probably going to be safe because it's 1-to-1 exactly when I look at the diff between Uniswap v2's repo and your repo. So there's not too much to worry about. And then if I see you added in like an admin rug function, then it sets off a red alert for us. So derivatives, usually are safe. Derivatives of each other are safe as long as like the code doesn't have something something pretty malicious in it. Other times we see derivatives, like derivatives of code where it's like the developer didn't understand the original intent of the protocol and they actually mess up. And so we see a bit of everything when it comes to like the code level integrations. What else do we see? Yeah, so like as I said before, as you integrate, it's like a litmus test for how good or how like well maintained the protocol is going to be at a code level. And then what was the third part of that question you were asking?
Yeah, like how do people kind of like price risk and risk harbor? Yep. and then like does an anonymous dev, is that protocol riskier kind of inherently because you don't know who it is, that sort of thing?
Yeah, so I think the biggest factor, as Teddy mentioned, was the test of time. Like the protocol's been around for I think 6 to 8 months, almost feels like like a very long time in DeFi. Like once you pass the 6-month timeline and you're actively managing 100 million plus, then people consider you generally safe. But there's one thing to understand. It's like, because one version of the contract was like for example, if their V1 was safe, that doesn't immediately say that their V2 is also like safe, right? So there's mistakes like that can occur as more complexity is added to any system, right? So as people add more and more features, it creates additional attack vectors. So you should never assume that because the first version is safe, the second version is automatically also going to be safe. And then like things like 0xCFU, Anon devs, you have to look at that and be like, okay, is there a multi-sig and is it controlled by 3 Anons? And what is the track record? Does anyone know? I'm like, again, these are human level decisions. There's no like algorithm be like, okay, checkbox, 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 and it leads to this score, which then changes the price of risk. It's all relative. You really have to just like consider on a case by case basis. But I think, it does influence like how the community perceives it. The most optimal solution is there is no multi-sig controlling it. The contract's logic controls itself, like its own treasury.
Awesome. Question for Teddy. It's one of the random audience ones. Like, what areas of centralized finance do you think are going to be the hardest or most difficult for DeFi to replace or to be built in DeFi?
That's interesting. I think that the hardest. So I think all right. Actually, I know what I want to say. So I think the hardest thing is the interaction with real world assets. So this is, I think, an opinion that I have, which I know many people don't share. But I actually think that getting real world assets onto DeFi is going to be very, very challenging. And I don't really see it happening in a big way in the near term. So that's stuff like houses, real estate, or just anything that is defined in the legal system. And because ultimately, like, if ownership is defined and exists in the legal system, then you need to be able to interface with that legal system. And DeFi like doesn't do that very well. And if it tries to do that, in my opinion, like it loses a lot of what, you know, its advantages, right? So like it makes it very difficult to scale if, you know, you have this system that's like entirely code based, except there still needs to be a human that like a corporate legal entity that sort of interfaces with the, you know, legal system. I think that that's actually quite challenging, and it's something that, you know, people have wanted to do and talked about doing for a long time, but it hasn't really worked. And I think it's just because like ultimately DeFi doesn't lend itself to doing that. You know, like DeFi isn't able to operate on the real world in the same way that it can operate on the blockchain, right? So it's like it's qualitatively different thing. So I think that is going to be the hardest thing. And my guess is the way that this is going to shake out is that it will be very, very hard to do that for a long time. And, you know, DeFi's growth is going to come from sort of DeFi native and crypto native use cases. So, you know, that's like maybe DAOs are going to be, in my opinion, natural users of DeFi, right? Because they are crypto native, blockchain native organizations that don't have access to the centralized financial system. Their only option for a financial system is DeFi. And so they are natural users of DeFi. And I see growth coming from things like that, right? And I think that the way the DeFi interacts with the real world is going to be, you know, further down the road, once DeFi has sort of gotten larger and larger, you know, maybe, you know, what'll need to happen is the laws will need to change. There will have to be legislation such that like something happening on a blockchain can actually like act on the legal system. And maybe like that's ultimately what needs to happen in order for DeFi to sort of move around real world assets. Yeah, anyway.
Yeah, I agree on that one. I think it's just it's a really tough problem. Next question is for Drew. Like, you know, what do you think is going to like catalyze or kind of push the next phase of DeFi adoption?
Yeah, so I mean, the way I look at adoption is with a focus on retail users. If we're just thinking like pure numbers, I mean, I'm just thinking more about the number of wallets and the people participating in ecosystem instead of like dollars. And if we're looking at through that lens, I would like the way I look at DeFi is almost like a hierarchy of needs triangle, right? Where people come in at the bottom, and that's where the most users will be. And then as you go every like one step up, you lose users as like complexity of these protocols increases, right? Or nicheness. So I think like the first layer is just stablecoins, right? So one thing I've learned, I mean, even there's like a lot of people like, okay, the US dollar sucks, right? There's a lot of people living in countries where their currency sucks so much that they're fine holding US dollars like indefinitely, right? And so I think that's always what I've considered the base layer of DeFi is just getting people into for people to hold currencies that are not like their own native currency, because like, you know, traditionally I feel like I can't like say for certain, but I feel like if you live in these places, it would be very hard for you to hold US dollar without going through a bunch of legal loopholes or being a high net worth individual. But nowadays you can just buy USDT, UST, or USDC on Binance or whatever exchange and hold it. And now you're not exposed to your country's, you know, deflationary currency. I think that's actually really relevant nowadays for the past month as people are trying to escape to various countries. They're moving their money into crypto and holding it probably in stable coins or like ETH or Bitcoin. So I think that's like the base layer. And so I think the thing that will push DeFi into its next phase of adoption is just better on-ramps for people all around the world. My philosophy is just get people on the train. It doesn't matter what cart they're sitting on the train, just get them on the train and then they'll figure out what they want to do from there. So I think, you know, as on-ramps develop for various different countries, as these exchanges play Fed Jitsu, as I call it, with all the regulations, so it's really easy for users to onboard. I think that will spark the next adoption cycle, because once these users are on like some stable coin, like the next step is for them to like go to notional and get something that's like equivalent to a CD, right? They put their money in, they park it. They don't have to know what's actually going on in the back end. They just know, hey, after 1 year, I'll get, 10% or whatever is the offer, the fixed rate offering. They can come to Risk Harbor, buy some protection. Again, maybe these two things are combined into one. So they go into their wallet, they press a button, it saves it for them, it protects it for them. They forget about it for a year. If they ever need funds, they can pull it out, right? They don't even have to know it's in DeFi. I think all those things are what will spark the next adoption cycle and bring in the next billion users.
Awesome. Yeah, that makes a lot of sense. Next question is for Teddy. It's like, it's a question that actually we get a lot as well. It's like, what's DeFi 2.0? Is it even a thing beyond, what people see on Twitter? Maybe talk a bit about kind of how you view that space and, what your opinion on it is. Is it just a marketing buzzword, or is there something else happening?
Yeah. So my opinion on that is I sort of see DeFi 2.0 as protocols that that aren't kind of the blue chip DeFi 1.0 protocols. So there's the kind of the initial phase of DeFi where a set of protocols came to prominence. You had Compound, Aave, Uniswap, kind of the names that you might call them DeFi blue chips. I think DeFi 2.0 is sort of it's the next step forward, right? Because I think DeFi 1.0 was like the very simplest, easiest applications that you could deploy, right? And 2.0 is the next step, right? So I would include Notional in that category. Now, I think a lot of the sort of DeFi 2.0 protocols, I think what makes it cool or what makes it special is that they interact with the other DeFi protocols, right? So a lot of these DeFi protocols are integrated with DeFi 1.0 protocols and build on top of them, right? Like Notional. So Notional is integrated with Compound, and we will also soon be integrated with Aave. And what that means is that actually all the capital that's sitting on Notional is actually sitting on Compound underneath, right? So Notional is an entire system that's built on this initial infrastructure layer of DeFi 1.0 protocols. So I guess that's how I consider DeFi 2.0. And yes, it is definitely a marketing thing, but it also it describes something real that's happening, right? Which is that you're building these new things that exist on top of the old things and that strengthen the old things, and also provide provide like a new set of services to people. Yeah.
Awesome. So the next kind of two final questions for each of you are kind of an interesting theme. So we'll go with the first one first. Drew, kind of basically show us your project. Like, what's the competitive landscape for Risk Harbor? What's your guys' edge versus the competitors? How are you different?
Yeah, so the competitive landscape, especially prior to us, it was I won't name by name. There's no reason to, but like basically what I'm saying is there's a lot of but our peers basically are are governance-based protection, right? And that means that the underwriters vote if you get paid out. This is similar to like what you see in real life. Like if you get in a wreck, Allstate sends a claims adjuster, they figure out how much you're owed. They'll lowball you. They'll be like, dude, was it really, like, should we really pay out? And then they'll finally pay out, right? But hopefully pay out. Thing in real life is it's regulated on state by state level. You have licensing, etc. On chain, you have none of that, right? So for these guys, it's a simple economic game. As an underwriter, you put capital forward. When it comes to time to pay out a claim, you'll figure out some way to not pay out the claim. We saw it, time and time again. And the beauty is you can look at it on chain, be like, here are the vote results, and here was the rationale. Even though users lost funds, it was pretty there were situations where it's clear cut. There was not payouts. And so a lot of users lost trust because this idea of DeFi is I don't have to trust anyone else. I just trust the code. But if I'm trusting people who I don't know that are misaligned, then this is worse than what I'd get in real life. And so that's sort of what the ethos of creating Risk Harbor was, there's a better way to do this. The contracts themselves can decide, and this matches the ethos of blockchain and DeFi. And so, Risk Harbor, the claims is completely automated, meaning that you don't have to sit there and talk with some anon or someone all the way on the other side of the world to convince them to pay their own assets to you out. Instead, you go to a contract, you call a function, and the contract looks at a bunch of different parameters that were set, before you bought this protection. And it checks those parameters. And if any of them are true, then it pays you out literally instantly, right? So a hack happens the block after, you can literally start filing a claim and get paid out 3 blocks after the hack occurs, right? And this is all because it's all automated on chain. The conditions are codified within these wrappers. So that's really the key advantage. I mean, there's other advantages, of course, like, there's a very, very few protocols that are both on Ethereum and on Terra, and soon other networks, right? It requires a good bit of engineering prowess to be able to manage, to build and manage on a bunch of different networks. But those are the secondary things. I think the core thing is that a claim is completely automated, and how that provides compelling value for policyholders and also underwriters, right? If you know the rules that you're going to pay out in, then you can properly gauge the risk. If it's ambiguous, then it's very hard to gauge the risk.
Yeah, that's a good way to put it about the risk. All right, Teddy, tell us about Notional. What's your guys' edge? Why should people use Notional as opposed to other lending protocols?
Sure. So, and actually, first thing I'm going to do is just shield Drew's product a little bit more. So, I think it's totally true that like the automated nature of Risk Harbor is awesome, and something that Drew didn't talk about, which I think is also really important, is that the fact that it is smart contract based means that you can create products which rely on it, right? Whereas like if it's a human-based insurance protocol, you can't create a DeFi product that uses that insurance because there's this off-chain dependency, right? Okay. So that's one thing. Now Notional, basically like the value proposition is quite simple. So it's a fixed rate of interest. And vis-a-vis our competitors, what I can say is that for other fixed rate protocols, Notional is by far the market leader in this space. So by any metric, whether that's TVL or the amount of loan volume processed or the lending rates that we offer, Notional is sort of the number one by many multiples. So purely from the fixed rate landscape in DeFi, there really isn't much competition. And then why you would choose Notional versus something like other lending options in DeFi, it's pretty simple. We offer a fixed rate of interest, and that means that exactly how much you're going to get from now until the end of the loan. So you can lock in an interest rate for up to a year, which is a big deal because like things in DeFi move incredibly quickly. The yield that you're getting today is not going to be the yield that you're getting tomorrow, and I think you've seen that. Like the market cycle turns, and then all of a sudden your yield goes to zero, right? Except not if you've locked it in on Notional. So that's the pitch. So it's high, attractive, fixed rates of interest.
Awesome. And then one more question for each of you guys. So maybe let's start with Drew. There's a lot of interesting things happening in this space. Outside of DeFi, you have like the whole NFT space, all this Web3 stuff. Everything's happening in gaming. What things interest you, in the space in addition to DeFi?
Yeah, so I mean, I'm a bit pessimistic on subsectors because like I came from a game background, right? Like the reason I mined Bitcoin was so I could buy Steam gift cards, so I could buy like in-game items, right? So, I'm not that deep into the metaverse stuff because I felt like that was created with like Roblox, Minecraft, and all that stuff like 10, 15 years ago. The thing that really interests me in the space, right, is it's kind of lame, but it's like a lot of the dev tooling that's being built, right? Because I use that every day, but it's like you have people that are literally sitting there making open source software, open source contracts, open source, like things like Hard Hat that could be building protocols, could be, creating life-changing wealth for themselves, but they're instead just doing open source tooling to make the dev experience easier to drive adoption. And that's like one of the favorite things. Like if you use Truffle and some of the other tools like 2018, 2019, it was really hard to develop contracts. Now, Hard Hat literally has a thing that you type in one command, you have everything set up, and you have a contract, you have tests, you have literally everything you need set up. And it's like, this is so amazing for developer adoption. I think there's so many like cool things being built on like the web front for users to build dApps really easily. Whether it is like used app, ethers, etc. That was like, we didn't have that in the early days of Ethereum. I mean, you probably remember it was like we had three contracts. We had a voting contract, the Hello World contract, and one other. And it was like, that's all you have. Go figure out how to build on this in this ecosystem. You're gonna do a bit of RPC. You're gonna have to sit there and manipulate hexadecimal strings. Good luck. But now it's just like so much easier that like the thing I really care about is like all this open source tooling, the dev experience, etc. Because I think that's really what drives like the flywheel. It drives everything, whether it's NFTs, metaverse, etc. is that dev tooling. If it sucks, then no one's gonna come in. If it's amazing, then you can bring in experienced developers, and you can also create new developers that are like their first dev experience is in DeFi. And so, yeah, that's the thing that interests me the most, like beyond, what I work on is a lot of dev tooling, open source, UX stuff.
Awesome. Same question to you, Teddy.
Yeah, I mean, I think so I'm a finance guy by my background, and I'm pretty focused on finance and notional and stuff. But I think like I'm interested in, because I'm not a gamer and I'm not super into the metaverse, but I find it really interesting as like a potential sort of growth area for DeFi. I like, because you hear stories about people talking, people buying houses and stuff and buying land in the metaverse. And I think it's so interesting. And like, I don't know, it'd be interesting to think about like getting a mortgage for a house that's in the metaverse. And like, how are you going to finance that purchase? Where is that money going to come from? And I think where it'll come from is DeFi. Right? Like that's going to be the financial system that is going to finance the construction of like this entire new space, and like, I think right now it's like the tech is just, I mean, it's too early to talk about that sort of meeting, because I think both DeFi and these other spaces are just like quite early right now. And there's lots of things that we each have to figure out before we can sort of, really start to enmesh. But I do see that happening in the future. And I think that that's going to be super exciting. And then otherwise, like, I'm interested in DAO governance, because like now that, something that Notional has been doing has been talking to a lot of DAOs about allocating some of their funds into the Notional protocol to earn fixed rates of interest. And just, it's really interesting to see the way different DAOs operate and like how decisions are made. And like, I think that, when DAOs are first sort of came about a couple of years ago, there's like mainly, it was very idealistic, the idea that everybody would vote on everything and it was going to be completely egalitarian and nobody was going to be in charge, and stuff like that. And then, and I think it's coming to a point where, it's becoming clear that this sort of initial idealistic vision is just highly impractical. And I just find it interesting just looking at these different DAOs and seeing them wrestle with like, how are you going to stay decentralized and operate within this sort of crypto native framework? But at the same time succeed and make decisions effectively. And I don't know, I find that very interesting and just kind of seeing how that all evolves. Yeah.
Awesome. Super fascinating. I appreciate you guys both coming on and taking the time to do this chat. It's been great talking to both of you.
Thanks, Joey.
Awesome. So next up, we're going to kind of just walk through a bit about Pantera funds. So if you look at the firm was founded by Dan Moorhead. He was head of global macro trading and CFO at Tiger back in the 90s. And we manage just a bit under $5 billion in assets in the blockchain and cryptocurrency space. If you look at our 8 funds over the last 8 years, our average IRR is about 80%. And it's split almost 50-50 between 95 venture investments and 100 early stage token investments. Of our deals, about 50% of them are ones that we lead, and we do about 40% of them outside the United States. And so if you look at what we're, offering to investors, we're offering, I'd say the kind of full spectrum of assets in the space. So early stage token investments, which is kind of more like venture, but they happen to be tokens that you're investing into. That's actually projects, like Risk Harbor and Notional, that sort of thing. Then we have our liquid token fund, which is a more liquid vehicle. It's trading things roughly in the top 100 or so by liquidity and trading volume. And then there's, our Bitcoin fund, which is just a basically index fund with Bitcoin. And then if you look at the Pantera blockchain fund, what's different about that is it's the first time we're offering everything in one vehicle. So offering venture equity in early stage and some later stage companies, early stage tokens, projects like 1inch and Eco and Origin and things like that. And then liquid tokens, which is more trading based. We do have a focus on DeFi within that portfolio, but also trading around things like layer ones versus DeFi, trading around Bitcoin versus ETH, basically doing a lot of relative value trades in that slice. And so if you look at the fund, we initially had a target of about $600 million. Now at this point, it looks like it's going to be something north of $1 billion total. We're having a final close at the end of next month. Go to the next slide. So the next couple of slides are sort of about why Pantera, and I think there's both a quantitative aspect to this and a kind of like more softer kind of qualitative aspect. And the qualitative piece is if you look at what sort of value add we provide to our companies. So one is that our investment team skew is pretty technical. We have a lot of people who have engineering backgrounds who either built projects before or kind of really understand the CS and economics behind what these projects we're investing in are building. Which is one reason why we win deals. The other is on the value add side. Franklin B, who heads up our platform team, works super closely with all of our companies, providing things like technical feedback, helping them with hiring, particularly engineering hires. Our GC and some of the other lawyers at the firm help provide the kind of legal pointers and guidance to companies. We've helped companies with M&A strategy. We've done some of the largest acquisitions in the space, where we've just been working closely with the company to help spearhead it and get the deal done, that sort of thing. I think the next few are like, one is we see almost every deal in the space just because we've been around so long, we're so active. We have a very large deal flow network. Paul knows pretty much everyone in the space. And then the last two, I think, are, network and kind of like experience level. I think what's interesting about our firm is we kind of have the 3 areas of, technical talent, finance talent, VC talent, all in one firm, and we're not really heavily concentrated in one versus the other. It's pretty diversified, which is, I think, unique across a lot of the partnerships in the space. And then the last piece is just, we have this network of founders, and founders often send us deals of other companies they're excited about, that they're investing in, or that they think we should check out. And so it kind of builds this, sort of virtuous cycle where if you invest in good companies and help them out, they end up referring other companies to you, and the kind of cycle repeats. But if you look at it from a more quantitative perspective, from a performance standpoint as well, Pantera's funds have performed quite well. Our first fund was up about 16x. Our fund 2 is an 8x, and our fund 3 is an 8.5x. And I think our fund 3 probably has more room to run. It's a 2018 vintage, so it's really only been around 4 years. The fund life is 10 years, of course. So I think it'll be much higher than an 8.6x when the fund is finally done. And then on the hedge fund side, those funds since inception, respectively, each early stage token fund about a 67% compound annual growth rate, liquid token fund 41%, and Bitcoin fund is 108%. That one was started way back in early 2013 when Bitcoin was just $65. And so if you look at it from a alpha generation or return standpoint, our view is that basically getting long Bitcoin or Ethereum is a great first step. However, active management does add, a lot of performance, especially because there's a lot of other assets in the space at this point that are, interesting to invest in. And so if you look at it from a return standpoint, our early stage fund, since from all of 2021 was up about 318%. Our liquid token fund was up 386% in 2021. Bloomberg, which is like kind of one of the bigger indices in the space, is up about 158%, and Bitcoin was up about 59%. So that's kind of the split of performance across the funds for 2021. And then if anyone has any questions, feel free to ask. There were a bunch for Drew and Teddy, but there's a couple ones that have popped up more recently. There's one that's, what are we expecting on the regulatory front? What areas of DeFi are most at risk of financial regulations, and in general, is regulatory stuff holding back DeFi development? I think if you look at DeFi, I don't think much has been held back from the regulatory standpoint on the retail side. Retail traders are still using the tech. I think it has been held back on the institutional side. I think from a risk standpoint, regulators are going to have to figure out a different way to regulate this space than they've regulated other sectors. A lot of the regulatory regimes don't necessarily make sense in a world where it's just software that's kind of autonomously operating. So maybe you look at things like regulating user interfaces as opposed to the protocols themselves. There's a wide range of ways to approach regulating DeFi, but I think it'll be many years before that's actually sorted out. I think there's a long kind of roadmap for that to actually happen. So I don't think it's really holding back, usage or price development, at least on the retail side, but it probably is on the institutional side. And with that, that's pretty much everything. If anyone else has any other questions or anything comes up, feel free to shoot us an email. Our emails are all of our first names at panteracapital.com. If you have a question about investing, feel free to send ir@panteracapital.com an email as well. Thank you, everyone.